me on your show. We are quite neutral to negative on FMCG. And if you look at the volume growth which has come through for the large FMCG companies, not just for this quarter, for the past several quarters, that's usually in low single digit or mid single digit. And whatever growth has come through in the top line is more to do with price increases which they have taken. And on the whole, I think the entire industry, at least it seems to be stagnating. Rural was a big kicker for the FMCG industry, but that also, I think, due to excessive penetration and generally maturity of the various categories within the FMCG space, I think for the next several quarters or years, you will find flattish to stagnant growth. And that doesn't really appeal to us in terms of getting higher returns. So FMCG is a good place to protect your capital. But if you want to grow your capital and create wealth, then you have to look beyond FMCG.
Dipan, just wondering what to do with IT. Of course, not a apple-to-apple comparison, but some of the global IT majors have disappointing numbers. And we're going to see a spate of them come out, over the next 10 odd days or so. But having said that, Indian IT has been quite battered here back home, right? We've already seen a 3-month of underperformance. Wondering whether they've fallen enough to be bought again and whether the fundamentals seem to be changing anytime soon to actually, look at buying also.
Yeah, see, I think you have to be patient in IT, and the time to sell certainly is gone, and you have to wait for this entire cycle to revive. See, the long-term prospects of IT are fantastic, whether it's large cap, mid cap, or even some other specialized IT companies. And eventually, when US, Europe starts to recover, IT spends also will come back to sustainable levels, and you will see excellent growth in coming through in these companies. But next, I think 2 to 4 quarters are pretty challenging. Of course, they've got the order books and the order wins in place to sail them through these tough times. But you will increasingly find that new order booking, discretionary spend certainly are going to come under pressure, and that will impact growth rates. So if you're already invested the way we are, I think it's best to just ride out this challenging period and look for better times in 2023 when the entire macroeconomic headwinds are over and done with. And then you can again see good volume growth coming through. In the meantime, I think some certain select mid-cap IT companies which are focusing on differentiated verticals or have IP type of businesses, those I think should be favored over the large cap IT. And with disclosure that we and our clients are invested, you could look at companies like Tata Elixir, KPIT, Persistent Systems. And also there are certain mid-cap IT companies which are extremely aggressive, and you have seen the numbers which have come through, like Coforge, like Mindtree, LTTS, and LTI. I think these are demonstrating industry growth rates beyond the industry growth rate. So you could focus on these companies.
Okay, so patience is the name of the game when it comes to IT, and mid-cap IT is certainly something that you're favoring at this point of time. But Dipan, what about the entire auto pack? There are fresh news flow suggesting that the likes of Volvo, etc. had to shut down the production because of chip shortage yet again. Do you think it can come back to haunt us? Or do you think that the demand and supply issues are pretty much priced in? And also, how are you playing the auto theme? Are you driving the SUV ride here? Are you looking at the two-wheeler space? What's your top bet?
We are going with the four-wheelers, be it tractors, be it commercial vehicles or passenger vehicles. And within that, of course, every passenger vehicle company has got certain products in the UV space as well, which are the fastest growing. Right now, I think the interest rate increases have not yet impacted the demand and the volumes in the auto industry. And I think if interest rates maybe go up by 50 basis points or so, it may not impact. And if petrol prices are around these levels, it will not be such a great dampener. So these are the two risk factors as far as automobiles are concerned. And if these are more or less contained, I think you will see a very good period next 2-3 years for auto companies. They have gone through a lot of challenges in the past few years, regulatory challenges, interest rate, NBFC crisis, and a lot of other changes which have taken place within the industry, like migrating to the phase 6 of the government regulation. And all of that had impacted volumes. But now I think the worst is behind them, and you could see excellent volume growth coming through from these auto companies. Margins are likely to be better because commodity prices also have stabilized. And so we are quite positive on the auto space. Usual disclosure that we and our clients are invested. I think the best auto pick remains Mahindra and Mahindra because of its capital allocation policy, because of the kind of products which they have in the market, and even the tractor division, which was a bit of a laggard, that has also started performing. So I think M&M should start is firing on all cylinders, and that could be our top pick over there. But Maruti and Eicher Motors also should provide decent returns going forward.
Kunal, along with